Investing in options has never been more popular, and it's easy to see why. Cheap exposure, infinite customizability, and the potential for high returns make these securities very enticing, particularly if you're a diamond hands retail trader buying naked calls on stocks you saw on Wall Street Bets. Yeah, don't try that at home. Options are clearly very risky, and most institutional investors don't just buy naked calls and puts to make directional bets on the market. So how can you really make the most of options? Hi guys, Joe here from Money Talks, and today we're going to take a look at how you can up your options game with 5 of the most popular spread trading strategies. I'm going to assume you have some basic level of options knowledge. If you're uncertain on what strike prices, maturities, puts and calls are, then take a look at the Investopedia links in the description. Without further ado, let's get started. So an option spread is simply a trading strategy where you take a position in 2 or more options of the same type, say 2 Tesla calls, to combine their payoffs in a favourable way. In this video, we will refer exclusively to European style options, which can only be exercised at maturity, as opposed to American style options, which can be exercised before maturity and make things a lot more complicated. The most basic spread strategy is a bull spread. As the name suggests, an investor would use this strategy if they thought the price of the underlying stock will increase. It involves buying one call or put option with a certain maturity and strike price, K1, and selling another call or put option with the same maturity but higher strike price, K2. The bull spread limits both upside and downside risk, and so would be useful for an investor who thinks the stock price may increase but isn't certain and so wants to limit their downside exposure. The solid line on the graph shows the profit from this strategy given the stock price at maturity, ST. We can build 3 different types of bull spreads. First, using 2 options that are initially out of the money. These are the most aggressive strategies, but cost the least to set up, so are great for the chads among us. Second, using one option in the money and the other option out of the money. Or third, both options in the money. These are the least aggressive, but are the most costly to set up. Best for the Virgin Fund investor. Next, we have the opposite of a bull spread, bear spreads. An investor would use this strategy if they believe the price of the underlying stock will decrease, and so are completely useless since stonks only go up. Bear spreads involve buying a call or put with a high strike price and selling a call or put with a lower strike price. As with bull spreads, these limit both upside and downside risk, and so can be used by an investor who thinks a stock price will decrease in the future, but isn't sure and so wants to limit their downside risk. If we combine a bull call spread and a bear put spread with equal maturities and strikes K1 and K2, we can create a box spread. The neat thing about this is that the payoff is always K2 minus K1. Box spreads are therefore great as an arbitrage strategy. Since we know its return will always be K2 minus K1, we can find the present value of any given box spread and compare this to its market value. If the two are not equal, an arbitrage opportunity exists, and you can buy or sell the box to make a profit. Next, we have butterfly spreads. These are slightly more complex and, like with box spreads, involve 4 equal maturity options, but this time with 3 different strike prices. A long call or put option with a low strike price K1, another long call or put option with a high strike price K3, and 2 short call or put options with a strike price that is halfway between K1 and K3. This strategy is profitable if the stock price doesn't deviate significantly from its initial level, but lead to a small loss if the stock price moves strongly in either direction. Butterfly spreads are therefore great for an investor who has a neutral outlook and thinks large price fluctuations are unlikely. Yeah, you won't find too many long butterfly spreads on Bitcoin. Butterfly spreads can be sold to have the opposite effect, returning a small profit if the price moves significantly, but but a small loss if it stays relatively the same. Finally, let's look at calendar spreads. The strategies we've covered so far all involve buying or selling options with equal maturities and differing strikes. Calendar spreads, on the other hand, involve options with differing maturities but equal strikes. Let's look at an example using call options. An investor would sell a call with a shorter maturity and buy a call with a longer maturity but equal strike price. The profit pattern for these strategies is similar to a butterfly spread. The investor profits if the share price stays relatively unchanged, but loses if large price movements occur. Once again, an investor can sell a calendar spread instead of buying it to produce the opposite effect, making a profit if the price deviates significantly and a small loss if not. That concludes our video on the top option spread strategies used by investors. Remember, options are highly complex financial instruments that should only be used by professional apes. Let me know in the comments section how much money you've lost on options. Biggest loss gets pinned. Thanks for watching Money Talks. Have a great day.